everybody. Luke Gromen, FFTT. Hope everybody is well and getting along as best they can. For my part, just got a great 6,000 meter row in a little bit ago on the rowing machine, and yeah, we're having fun with the boys at home as best we can in these trying times. So thanks for joining me here tonight. Before we jump off, I wanted to let everybody know that we have a special promotion going for our product tree rings right now. It's a March 31st deadline. Starting on April 1st, we are increasing prices, but you can lock in the price for life, and your first month is free. As also, you will get bonuses if you sign up before March 31st. You'll have access to all webinar replays, complete archive access to our back issues as far back as August 2019, full access to a new community forum that we've opened up where you can share and learn from other Tree Rings members, our top 20 book recommendations, like we said, price guarantee for life, and 4 free bonus weeks of your Tree Ring subscription. So have to sign up by March 31st. We're really excited about it. We've made some big investments in the platform, like I said, with the community forum, as well as the ability to offer all the back issues. So we're really excited to offer that. So if you're interested and you like these updates, check it out. I think you'll really like Tree Ring. So with that, we're going to jump in with the 5 questions here. So first off, from B, what's the short-term and long-term impact on the dollar? How much of a driver will the dollar be going forward? The bottom line is the dollar's key. Near term, dollar should go up as the U.S. dollar short squeeze continues and worsens, and just for summary, you have a dollar short squeeze because foreign banks have the ability to make dollar loans but cannot create dollar-based money with which to repay those loans. And so as these economies collapse as a result of coronavirus, you end up with this giant cash call on dollars. Longer term, either the Fed will print enough base money or the system will collapse. And it's basically getting to that point now. And that's going to happen relatively rapidly because the debt amounts are so great and the dollar shortage is so great. As the system nears collapse, the dollar system, the dollar-centric system nears collapse, we will paradoxically see the dollar go up and up and up. It's a sign of collapse because it's a shortage. You'll know you're getting near the collapse, though, because you will start to not be able to buy real goods with your quote-unquote strong dollar. And the real key for me is when you start not being able to buy physical gold with your quote-unquote strong dollar, at least at paper prices. And so you're starting to see signs of that. Premiums have blown out at the retail level. For me, that's sort of step one. But the key is 2 things. Number one, wholesale price premiums starting to blow out on physical gold relative to the paper price you see on your screen. And B, the bid side, right? We're seeing premiums on the offer side rise, but not the bid side. Once we see the bid side move above the price we see, the paper price we see on our screens, that is, I think, a key sign that you're getting, the dollar spike is nearing creating a systemic collapse situation. So there's no limit to how high the dollar can go, but like we said, there is a limit to how high it can go before the system collapses and treasuries nominally default and or the U.S. interest payments on treasuries is paid entirely with printed money. Real good shortages emerge. It's not a good scenario. So long dollar is a good idea, but again, once you start hearing of gold shortages, especially at the wholesale levels, it's a warning sign that the dollar is failing in gold terms, and that hints at the amount of money printing that is likely to come because physical gold holders just sit tight and say, I'm not going to let go of my gold at those prices because I know the amount they're having to print on the other side. So gold holders like myself say, yeah, I'm good. Show me a better price. So the longer this goes on, the longer the dollar goes higher, the more it means either the U.S. government has to either default nominally on the treasuries as the dollar rises up and up and up, destroying the real economy needed to support the tax payments that support treasury markets, or the real value of treasuries gets impaired as the Treasury and Fed do enough printing to keep the system afloat. So question 2 is uplifting stuff. I apologize, but this is where we are. Question number 2 is from JP. How long can the dollar doom loop continue without intervention? The answer is not that long. We've been saying, if you have closed borders and you have closed stores, you can't have open financial markets because it's a system that is short cash by definition. It's a fractionally reserved banking system. And so Whether it started off with relative value hedge funds needing to sell a couple weeks ago, driving cash margin calls. Now we're going to get into small businesses. They're going to go dump their 401ks to raise cash to make payroll, make rent, make inventory. And so there's all sellers, no buyers. And so you get a doom loop. It's a one-way trade. And so it's not impossible to watch equities to go towards zero in this scenario relatively fast because of how levered the system is. And the only way you can get cash is by selling your financial assets in markets that are still open while the rest of the economy is severely impaired or closed. And so the question is how long do we have? Not long. Not long. The second side of this is that the U.S.'s net international investment position is negative 55% of GDP. We've never gone into a recession with the NIIP this negative. And this is where I've always had a problem with Brent Johnson's dollar milkshake. I've agreed with him that, look, in a crisis, the dollar's going up and up and up. I get it. Where my problem has been is when you understand that the NIIP is this negative, his case is the dollars are going to flow here and bid up our assets. My point is the NIIP, that negative, means the dollars are already here. You know, when you run a negative 400, when you have a 400 to 500 billion dollar deficit against China for the better part of 20 years, that's $8 to $10 trillion that the Chinese got in dollars and turn around and reinvested in our markets over a 20-year span. And so if China is having a dollar shortage, guess what they're going to sell? They're going to sell their dollar assets. And so that's just another way where we're going to have this doom loop cash suck. So as the dollar goes up and up and up, markets are just going to go down and down and down. And like to be flip but honest, there's a hard floor on equity markets at zero. They can't go below zero. But I want to impress upon you how serious a situation this is in terms of this dollar spike and what it implies. Now, does that mean I would run out and sell all my equities? No. We would not, because on the other side of this, number one, this can't last very long. If it does, we're all going to have bigger things to worry about than trying to figure out where our 401k is priced. You're going to want to have that physical gold, hopefully, that you own, and the system's going to reset with physical gold, probably with at least 1 0 added to the back of it to provide the dollar liquidity needed. Ultimately, I have a hard time believing they're going to let the system go to zero. I don't think that's going to happen. And so, basically, personally, I would be nibbling at blue chip franchises here where they have good balance sheets. They're going to make it to the other side of this whenever the Fed finally does get to printing enough, because they're going to print enough. There's no limit to that. And when they do that, boy, it's going to be really, really good for U.S. equities. So that's where I stand on that. Number 3 from Jeff. In the past, you've said that the Fed leveraging the balance sheet and weakening the dollar would be good for risk assets like industrials. Are you now abandoning that strategy in favor of gold only? No, is the short answer. What we would say is that we've been writing that much more about wanting to only own gold miners, silver, Bitcoin since January, since the mid to end of January, when we wrote to our subscribers that we're becoming cautious in the near term, simply because the Fed stopped growing their balance sheet. Our case all along has basically been that if the Fed's balance sheet's growing, then the dollar liquidity is increasing, and that's a good environment for risk assets and industrials, etc. But if the Fed stops doing so, the U.S.'s deficits are going to crowd out the world. And Fed stopped growing their balance sheet in early January. By mid-January, it was obvious it would seem to be a strategy. They actually thought they could do it without breaking the world. Coronavirus ended up being the snowflake that sort of created the avalanche proverbially, and of course it's a lot more than a snowflake. But for us, I still think industrials, risk assets do really, really well on the other side. And like I said before, would be nibbling on some blue chips with good balance sheets. But what we're describing here is really a very binary setup. And by that I mean, as long as the Fed's not printing enough, equity markets are going to head towards zero for that cash margin suck reason we discussed a bit ago, and the net international investment position. As everyone else in the world scrambling for dollars, they're just going to sell U.S. equities all the way down. And so the Fed better get on top of this fast. Treasury better get on top of this fast. And so you get this very binary, almost asymptotic decline in equity markets until we head towards zero. But on the flip side of this, you're going to get a reset in the dollar, and the equity stakes you're definitely going to want to own equity stakes relative to bonds, whose real value would likely be impaired potentially pretty dramatically in real terms relative to what they're going to need to do the dollar to get out of this now. So that's that's where we stand. So they let's see, number 4. From a Luke, if by a magic wand the world were to get rid of COVID by midnight tonight, does all come back to normal, or are we broken far enough structurally to not make a comeback this time? It's a great question. I think we would still need massive QE at this point. Remember, we've been writing in tree rings how far above the carrying capacity of debt that we are, and that basically, if our example, and I think we even used it on one of our periscopes, showing what's the scariest chart we've seen, and we highlighted the St. Matthew's Island reindeer metaphor, where the reindeer had no natural predator. The amount of reindeer went from 60 reindeer to 2,500 reindeer over 20 years. And then you had a bad winter, and they went from 2,500 reindeer to 40 reindeer in a straight line because you were so far over carrying capacity. And it's the same thing here in terms of carrying capacity of debt. We are so far over it. If we just had one bad winter, and we wrote about this in Tree Rings back in January, you have one bad winter, the whole thing can come unraveled very rapidly. And we speculate, hey, is COVID the bad winter? We hope not, but it seems possible. In hindsight, yes, it was. And so the punchline is that, if it stopped tonight, our guess is you'd probably need to see the Fed's balance sheet go to $8 to $10 trillion structurally and stay there just to sort of stop the bleeding. By way of reference, we are, we were at 4.2 trillion 3 weeks ago. We've grown at a 7.4 trillion annual rate for those 3 weeks. We grew at a 17.5 trillion annual rate last week alone. So you'd still need pretty dramatic balance sheet expansion, but I think you could probably stop at only 8 to 10 trillion. If they don't stop it here, I think the Fed's balance sheet is going to a multiple of 8 to 10 trillion over the next few years. So that's how I'd answer that. And then finally, question number 5 from CP. I have part of my net worth in physical gold. Everybody's talking about a deflationary depression, which looks to me a likely outcome. I agree. In a deflationary environment where real rates are positive, gold might underperform. Should I sell my gold and buy it back in 6 months' time? I would say no. I would not do that. And the reason is that deflationary depressions are bad for debt. Here's the catch. We're in a global sovereign debt bubble. Biggest global sovereign debt bubble since after World War I. And so we haven't seen this in a long time, but what it implies is that there's, going back 120 years in research data showed by Carmen Reinhart and Belen Zabrancia, past 120 years of history, you've had these sovereign debt bubbles in emerging markets and advanced markets going back. They're always resolved one of two ways: default or restructuring, or inflation. They inflate it away. So if we have a deflationary depression with a global sovereign debt bubble, either global sovereign debt is going to default on a widespread basis, and what backs sovereign debt? What's the asset? There's no plant, there's no property, plant, and equipment. Chinese can't show up and say we're gonna take Yosemite National Park as collateral for the treasures we own. We just don't pay them. So either sovereign debt defaults globally, treasuries, JGBs, all of it, or they inflate it all away. And there's in the paper by Sabrancia and Reinhardt, it's inflation, financial repression, and a few hyperinflations each time. So the way we think about it is it's a deflationary depression, which means global sovereign debt is about to either be defaulted on or restructured, and if treasuries are no longer a safe asset, that's good for gold, or they're about to be inflated away on a real basis, which is also good for gold. So no, I wouldn't sell my gold. I understand the strong dollar, deflationary side. If they don't print enough, sovereign debt globally is at risk of nominally defaulting. And that is the thing that most people, they don't even think about it because they haven't had to think about it. But it's the same. The last time we saw sovereigns in this situation, it was in the emerging markets in Latin America in the 80s, in Southeast Asia in the 90s. And the last thing you wanted to do there was sell your gold in favor of holding government debt. So at any rate, that is it for tonight. I thank you all for joining me. I hope all of you stay healthy and safe. and I look forward to catching up with all of you again. And again, if you enjoy these updates, check out tree rings. As I said before, March 31st, we're raising prices. We've got a bunch of new investment we've made in the site, make it much more functional, interactive, and informational. So really look forward to having you check that out, and look forward to chatting with you soon. Stay safe, stay healthy, everybody. Take care.